Hey, how's it going, everyone? Welcome to Finance with Avrin. In this video, I'm going to get into details about section 70203, which is no tax on car loan interest in the One Big Beautiful Bill Act. And this bill, of course, is massive, over 900 pages, but I'm going to get some specific details about this section of the One Big Beautiful Bill. And I'm definitely still doing videos about high yield accounts, investing, bonuses, and so forth. But I want to continue this series as well about certain sections in this massive bill because I know it's going to affect a lot of people in regards to their personal finances. And if you like this video, be sure to like it down below and subscribe to the channel if you're not already. All of that is much appreciated and helps the channel. Let's get right into this bill right here with some specifics. First, a little overview here. No tax on car loan interest. What does this mean? This section of the Big Beautiful Bill creates a temporary deduction from the years 2025 through 2028 for interest paid on personal use car loans. So yes, this is retroactive. This applies to loans that have incurred after December 31st, 2024. So as of January 1st, 2025, if you bought a car on that day or after any time, then this would apply to you. If you're thinking about buying a car up until the end of 2028, then this could apply to you. And that's the stop date as of now, 2028. They could extend this in another bill with the next president, so forth. We'll see about that, of course, when that time comes. So if you sign a loan for 5 years, 6 years for a car, it's not going to cover those additional 2 years after that additional year after that. It's just going to be for the 4 years of that loan unless this gets extended. And for this deduction, it must be secured by a first lien on the vehicle, which is basically stating that the lender has the first priority of the vehicle and can use it as collateral towards the loan. So, defaulting on the loan, something happens to the loan, the lender can obtain the vehicle and use that as collateral. That's a typical thing with car loans. So if you're just unsure about it, you're buying a car or something, you might want to ask them that. But typically with the lenders of the vehicle, they're going to have a first lien on the vehicle and it must be secured by that for this deduction. And also this deduction is an above the line deduction. Itemization is not required. This could be filed on taxes if you use the standard deduction or the itemized deduction, either one. You don't have to use one or the other to have this car loan interest deduction. Let's get into some specifics about vehicle requirements. Now, to qualify for this deduction, the vehicle must follow these requirements. It must be an original use by the taxpayer and a new vehicle for that taxpayer. So you must be the first person to use the vehicle. This deduction cannot be applied towards used cars, used vehicles, even if you have a loan on it. Even if that loan is new, the car is not new. Must be for new vehicles. And the vehicle must be built for public road use, not rail or off-road use or anything like that. The vehicle must have 2 or more wheels. It could be a car, van, SUV, pickup truck, or motorcycle. And also the vehicle must be classified as a motor vehicle under the Clean Air Act. That's just specific about what makes a motor vehicle basically. It's not like EV only, electric vehicle only, anything like that. I know that Clean Air Act might throw some people off. This deduction is not just for EV vehicles like the EV tax credit, which there is some crossover with that tax credit in this bill. And I'm going to tell you about that, how you can actually take advantage of both of those specifically later. Now, also back to vehicle requirements. The vehicle has to have a gross vehicle weight of less than 14,000 pounds. And also really important here, the vehicle must undergo final assembly in the United States. So that means, when it comes to manufacturing the vehicle, when they're finishing it, pretty much getting it ready to put on the car lot, it must be final assembled in the United States. The vehicle can be a foreign vehicle. It can have foreign parts, but it just must be final assembled in the United States. So yes, this isn't just for domestic vehicles, Ford or Chevrolet, anything like that. This could be applied to Toyota and Honda and so forth, just depending on if the final assembly is in the United States. That's the key requirement right there for those vehicles. And also there's actually no limit on the cost of the vehicle for this deduction. It could be $50,000 vehicle, $40,000, $20,000, $120,000, $200,000, $500,000. Whatever you're going to buy out there, this deduction can go towards any kind of vehicle cost, no matter how much the vehicle costs. I was a little bit surprised by that. For some reason, I thought there would be a limit on that, but there's not. Now let's get into some specifics about qualified interest and loan rules. Now, for the actual loan on the vehicle and the interest on it, for the qualified interest on that loan, for it to be, qualified for you to be able to deduct it, the interest on the debt must be used to buy an applicable passenger vehicle for personal use. And also, you must report the VIN number, the vehicle identification number, on your tax return to qualify. So you must have that new vehicle with a VIN number. Now, also what's excluded? There are certain loans that would be excluded from this deduction. Fleet or commercial vehicles not used personally. Leases, this is not available if you lease a vehicle. Salvage or scrap parts intended vehicles. Can't be for that use, must be a new vehicle for personal use. And also loans from created parties are not qualified for the interest deduction. Now what that means basically is that loans from a close relative or certain business entity that you control. You know, if you own the place that's giving the loan, if your brother does, your sister, your son, your dad, something like that, then no, you can't get a loan from a place that your close relative owns. Also, refinancing is allowed, but only if it is still secured by the same vehicle. So yes, you can refinance that vehicle, to get a better interest rate and so forth, and it will be still available for this deduction. Just has to be a refinancing of that same vehicle that you already bought that was new. But also one thing to keep in mind with refinancing, the balance cannot exceed the original loan amount because this prevents deducting interest on any extra borrowed amount during refinancing. So if you refinance the loan for your vehicle, the balance cannot exceed that original loan amount. So two requirements right there for refinancing to be able to still have that interest that you're paying on the refinance loan be eligible for the deduction. Now let's get into some details about deduction limits and income phase out. Now there is an annual cap for this deduction. You can deduct up to $10,000 in qualified interest paid each year, not more than that, even if you pay more interest than that. That is the cap for the actual car loan interest deduction, $10,000. That's the most you can deduct annually on your tax return. Now, also, this is, of course, a deduction on your tax return. It's not saying you're not going to pay taxes on the vehicle loan. It's just for a deduction. So not saying you're going to be able to look at that amount when you're signing the papers, for the vehicle and just mark off the taxes. No, you're still going to be paying that. It's just going to be able to be applied to a deduction on your taxes when you file them if everything meets the eligibility requirements. Now, there is a phase out with this, similar to some of the other phase outs with the sections of the One Big Beautiful Bill. Now, for the car loan interest deduction, the deduction is reduced by $200 for each $1,000 or portion thereof your income exceeds. For single filers, $100,000. For joint filers, married filing jointly, $200,000. And portion thereof means that even if you're $1 over, the full $200 is subtracted. For example, for that portion thereof, if you're filing jointly and your modified adjusted gross income is $200,001 for that year. And let's say you had $8,000 worth of car loan interest. Even though you're $1 over the phase out, it's going to basically round up to you being $1,000 over. So you'll have to deduct $200 from that $8,000 in this scenario of your deduction that you're able to deduct on your taxes for that car loan interest. So instead of $8,000, it's going to be $7,800. Even though your modified adjusted income was just a little bit over the phase out levels, it rounds it up basically. All right, let's get into some examples for this car loan interest deduction. First example scenario here is a full deduction qualified amount. In the scenario, in 2025, Toretto is a single filer with a modified adjusted gross income of $85,000, and he purchased a new Dodge Charger that was assembled in the United States. In the year 2025, Toretto paid $7,200 in qualifying loan interest. His modified adjusted income is under that phase out amount of $100,000, so he has no reduction in his deduction. He can deduct the full $7,200 of interest that he paid in 2025 on his taxes that he's filing in 2026 for the year of 2025. All right, example number 2. This is a high income phase out example. In this scenario, in 2026, Brian and Mia had a modified adjusted gross income of $215,000 and purchased a new Rivian R1 that was assembled in the United States. They filed a joint tax return as a married couple. Now, in 2026, they paid $9,500 in qualifying interest. Their adjusted gross income exceeds the joint limit phase out by $15,000. Remember that phase out for joint tax returns is $200,000. Brian and Mia are over that by $15,000. So let's get their reduction amount. It's going to be, remember, for every $1,000 or rounded up $1,000 over the phase out amount, you have to reduce the deduction by $200. So they're over the phase out amount by $15,000. We're going to divide that by 1,000, which is going to equal 15. 15 times 200, that's that reduction amount. That's going to equal $3,000. So that's their phase out reduction amount. So they paid $9,500 in qualifying interest. We got to take away $3,000 from that. Their deduction goes down to $6,500. That's how much they'll be able to deduct on their taxes for 2026 that they're filing in 2027. All right, now, like I mentioned a little bit earlier in the video, there is a way that you can still take advantage of the EV electric vehicle tax credit and the car loan interest deduction, depending on some specific details. I was thinking this in my head. I was like, hold on, this could have some crossover. And I noticed a couple of articles, and the USA Today article really breaks it down nicely. So to avoid this video for being too long, if you want to know definitely a lot more about this specifically, definitely check out that article after you finish my video. Now, let me just tell you about an overview of this, and we're going to wrap up the video here. The EV tax credit was supposed to expire, I believe, in 2032. Part of President Trump and the One Big Beautiful Bill is ending that EV tax credit earlier. So after September of this year, that EV tax credit is gone. That's it. However, it's still in effect. And this car loan interest deduction is retroactive. So it started at the beginning of 2025. You see the graph right there, little crossover and the time frame. If you meet the qualifications for you personally, for your income, for the EV tax credit and the car loan interest deduction, and you buy a vehicle that meets the requirements for the EV tax credit and the car loan interest deduction between January 1st, 2025 and September 30th, 2025, then on your taxes for 2025 that you're filing in the beginning of 2026, you could qualify for that EV tax credit. I believe it's $7,500, the main one overall there. And as well, you'll be able to qualify for the car loan interest deduction for 2025. Now, of course, that EV tax credit is one time, so that's just going to be on your taxes that you filed that time. And then the car loan interest deduction goes into the end of 2028. However, I'm saying there's a chance, there is a possibility where you could qualify for both, depending on your financial situation and the vehicle that you've purchased or are going to purchase up until September 30th, 2025. So wanted to mention that right here as an example. If you want to know more specific details about this, you know, the income amounts for the EV tax credit, the amounts, and you know how they can work together with this car loan interest deduction, I'm going to refer you to that USA Today article right there. It's not sponsored by them or anything. It's just a really nice article breakdown, and I don't want to make this video go on too long. Now, there are some lender requirements. So the company that is giving you the loan for the vehicle, they must file an IRS report if the interest they receive is $600 or more. And in that report, they must have the following details: borrower's name and address, interest paid, loan balance at the start of the year, loan origination date, and the vehicle year, make, model, and VIN number. And also, they must send a statement to the borrower, you, the person, you know, who has the vehicle and the loan. They must send you a statement by January 31st of that following year. So you'll have that amount right there of the interest that you can report, possibly depending on some other factors that we went over earlier in the video. So you'll have that amount. Now you can keep up with the interest you paid yourself, of course. Definitely, if you want to break that down, have it, you know, just in case you want to compare it to what you get sent on that statement if you want to, or you can just rely upon that statement. But a statement should be sent to you each year for the interest that you've paid on that vehicle via that loan. Now, with IRS enforcement of this, the Treasury may issue rules to avoid duplicate reporting, to make sure, you know, you're not having interest paid twice, you know, and being able to deduct, you know, a double amount, or the lender saying this amount and it wasn't that amount, things like that. They'll be checking into this. And also, there are penalties for non-compliance. If that lender does not file that IRS report, they could get into some trouble. So yes, there's definitely some accountability for this car loan interest deduction for the lender as well. All right, everyone. And that is it with my video on the car loan interest deduction in the One Big Beautiful Bill. Hope you all enjoyed it. Take care.